have, and now I think that rally is coming to an end. And we would be, in my view, just in the early stages. I think in some ways to think about it from a broad perspective is this is the third big dollar rally we've had since the end of Bretton Woods. We had the Reagan Volcker dollar rally, late 70s into the mid 80s. We had the Clinton dollar rally, that would have been like the second half of the 90s. And now we have this Obama-Trump dollar rally, and I think that's turning. And so, for give you an example, in the last peak in the euro, we got up to $1.60. We fell to about 105 or so, 106 during the pandemic, with the heat of the pandemic in March. And so today we're trading above 116, and it wouldn't surprise me to see a 120, 118, 120 by the end of the year. And then I just think it continues to go for the longer term for several years. I think that's what we're on the cusp of. And I think that that could carry the euro back up towards, say, 130, 135, something like that eventually.
So, and I guess the reality is that, as much as gold prices have rallied this year, the market still hasn't priced in significant dollar weakness.
Yeah, no, I agree with you. I think that gold is serving a lot of different functions now with those low yields. It looks like bonds aren't really offering a hedge to equities. And so I think people are finding new purposes, new use for gold during this, say, such low interest rates. And not only now, but for so long. I mean, that is, we're going to have them. I think the Federal Reserve, which meets next week in June, had suggested, I think 15 out of 17 members were saying no rate hike until late 2022 or early 2023. And the U.S. isn't alone there, of course. Many other countries are going to be looking at low interest rates for a long period of time, and how you find out a hedge, what works. So I think that what people are doing now, they can buy gold and the stock market. And when the risk assets, really, instead of just the stock market, but risk assets, and those risk assets sell off, gold might sell off as well, but maybe not as much. It's still a safe haven for many people.
It's hard to look at the 10-year at 60 basis points as that traditional safe haven asset.
Yeah, no, I think you're right there. So I think that what happens in a safe haven when in an emergency, when like the end of days is at hand, I think what makes it a safe haven, I think it's sort of more like along the lines of, it's not so much the return on your assets then as the return of your assets. And so the security of knowing you've got the biggest and most liquid bond market in the world, and that includes really the bill market too. So that's really the safe haven. I think the dollar just sometimes benefits from that. And so in some ways what we're talking about here is that old dollar smile, where the dollar does very well in bad times or very good times. And I think now it's more of a crooked smile, where the liquidity that the central banks are providing, the government stimulus by the fiscal stimulus that's being provided, I think is really encouraging people to buy risk assets, and that's really the sort of the undollar, if you will.
So, just looking at interest rates, then, I mean, do you see them going lower? And what are your thoughts on a potential yield curve control from the Fed? I mean, is that becoming a reality, or is that moot as we see just yields not growing anywhere?
Yeah, so I think you're right. I think that we should be expecting more monetary efforts as well as more fiscal efforts. And this has really been a big body blow to the economy, and we're only seeing gradual signs of recovery. And some of those high frequency data, maybe the economy might be stalling out. So I do think the Federal Reserve wants to do more, and I think that maybe this next week's meeting at the end of July a little bit too soon. But probably by September, they'll be prepared to do something more. And I think that you're right. Yields are very low. We just hit a new record low in the 5-year a week or two ago. We're slipping through 60 basis points on our 10-year. Our 2 years within a few basis points of its record low of around 10 basis points. But I think that the yield curve control, which I do agree that's what the Fed seems to be moving towards, would not so much be just to cap yields, but it would be sending a powerful signal to market participants that yields will stay low. And I think it's part of more of a forward guidance. It probably won't involve so much having to buy treasuries. As we've seen, the Bank of Japan and the Reserve Bank of Australia have their own versions of this yield curve control, and they haven't had to buy that much debt for it. But I do think that the Federal Reserve is going to be concerned that the economy may be stalling, and maybe stalling at levels of unemployment that are still unacceptable. So I think that the Federal Reserve is going to have to expand its balance sheet again as well. So yield curve control plus some new balance sheet expansion. Initially it was about stabilizing the markets, And I think most people agree the markets have been stabilized. But the second phase of what the Fed's got to do is really support the economy. And I think that will necessitate expanding its balance sheet further.
So, I mean, obviously, if we look at the economy, and COVID-19 completely decimated everything in the second quarter. 20 million job losses in May and June. What do we go back to those lows, do you think? I mean, we are sort of seeing the pandemic sort of reemerge again in the U.S. and states having to look at lockdown measures and other things. And I'm sort of wondering, I mean, do you think? And we've heard the president say, things are going to get worse before they get better. Do you think we go back to the lows?
The lows. Well, I think that so something like this. Towards the end of next week, we'll have the first look at Q2 US GDP. And it looks like the market's consensus is very close to the Atlanta and the St. Louis Fed GDP trackers. That is a contraction of somewhere around 34% at an annualized pace. It's really historical, right? We're already a month almost through the third quarter. So Q2 will be interesting from a historical point of view, be the deepest contraction we've ever had. But the real focus is on Q3. The New York Fed's model suggests that Q3 could be expanding by around 13%, and the market's a little bit above there. So what I sort of see happening is that the stalled reopenings, some of the reversals, are impacting some of the high-frequency data, like air travel, like the reservations on Open Table. You can see this in other, like, say, high-frequency, like daily economic activity models that, say, Bloomberg runs. And so I think what that's going to do is going to shave the kind of rebound we're going to get. But I don't think we're going to go back to a national shutdown. Give you another example of what's happening is we saw a big jump in the June industrial production figures led by manufacturing. And the story there is that the auto industry practically shut down completely. Output in the auto industry just jumped 100% month over month. And so I think this is the kind of momentum the economy has, and these kind of the new flare-up, which is very serious, I think is going to curb how strong of a recovery we get in Q3. Maybe it shifts some into Q4, depending, of course, as you say, on the course, if you will, of the virus.
So with all of this going on, you say, the how high gold prices go, that's the $2,000 question. Do you think we get to that level by the end of the year? Do you think we need to take a little bit longer to get there?
Yeah, that's a good question, because I think that what happens is we're in the midst of like a lot of momentum right now, and it's easy to project the momentum like in a straight line. And I think that really early in my career, an early boss told me as I was like making a recommendation to buy the foreign currencies after they were already up a lot in the futures market. He called me into his office and he said, "You either don't have any scar tissue or you're foolish." And I opted for not having scar tissue, but now I think I have enough scar tissue where I think it does make me cautious, seeing the strong upward momentum. And I do look at the technical indicators, and a lot of those are getting stretched as well. So it's not a question for me of like liquidating my gold position. It's more a question of being prepared for a pullback and letting me decide whether I want to add on. I think that, like I say, I think the dollar has turned in a big way. I think that we have some upside still on gold. And my 2,000 might just be a conservative estimate. It's just a little bit above the record high.
That's a fantastic. Thank you very much, Marc. This has been a really great conversation. I really thank you very much for your time and coming onto the show.
Great. Thanks a lot for having me, and I look forward to talking to you again.